Hello and welcome to your Global Markets Technical Outlook for the end of quarter 3, slightly delayed this time, 2022. Normal disclaimers apply, of course, and for the quote this time we turn to Anonymous, who says sometimes the best trade is no trade. And as we'll see when we get into the state of the stock market at the moment, that certainly seems to be the case for many people. So, turning now to the US stock market on the monthly chart, S&P 500, and while we can see that it's now clearly, broken that 4,000 key level, it's got quite a bit of momentum and volatility behind it now. The all-time high of 4,800 now seems like a bit of a distant memory as we head towards that line of previous resistance at 3,400 and see if that will act as support if and when it does arrive there. And on the weekly chart, you can see that the pullback that we're seeing is quite corrective in nature. We have these overlapping highs and lows. It really hasn't been a high volatility maneuver, certainly nothing like we saw back in 2020 or even 2008, if your memory goes back that far. It does feel much more like a correction rather than a bear market that we're in, despite the thickness of the sentiment that's around at the moment. So we'll see what happens if and when it reaches that 3,400 level and whether it can establish some level of support. On the Ichimoku chart, though, it has crossed the cloud now, so it's definitely in bearish territory. The lagging line, or Chiku span, is also through the cloud, and that does tell us that we are now in bear territory. And then we have to look above to the overhead resistance that the cloud now provides, and that's sitting around about that 4,300 mark, which is, a fair way up. That's like 600 or 700 points higher than where we're sitting right now. Switching to the market fundamentals, and if there's only one chart that you really need, I think, that explains what's going on in the stock market, and that's really what's happening with the Federal Reserve's balance sheet. The red line here indicates the liquidity of the Fed's balance sheet, and when they're quantitatively easing, the red line goes up, and then when they switch to tightening, as they have done since the start of this year, you can see their balance sheet is shrinking, and that correlates very well with the S&P 500 here in orange. So that's definitely what's driving this market. Obviously, the Fed want to fight inflation at any cost at home, and that means that there will be pain not only in the stock market but also in the foreign exchange markets, as we'll see when we get into that in a little while. But looking at the stocks themselves, the market breadth for the S&P 500 is now just 22, so just a little more than a fifth of stocks are bullish at the moment. However, when we do get down to these very low levels, below 15 or so, it has been the point where the market has rallied in the past, and we'll just have to see if that eventuates. At the moment, it certainly doesn't look like it's reacting just yet, but let's see what happens in the near future. The market's obviously very oversold, so a bounce of or a sizable bounce even would not be out of the question. On the NYSE, stocks above their 200-day moving average is a very similar picture, just sitting around about that 17 level, which is obviously very low. And again, it shows a similar pattern of rallying off those very low levels. So we could be at some point. And when we have a look at the seasonality in a moment, you'll see that things may just be turning positive for the back end of this year. Discretionary versus staples, of course, a very good leading indicator for the broader market, the S&P 500, and of course it's in a serious downtrend to try and rally through the middle part of this year, but it's dropped off again, and we really need to see this turn up meaningfully and start to make higher highs and higher lows for the market to have any chance of rallying itself. And when we look at the semiconductors as a ratio against the S&P 500, also often a good leading indicator of the broader market, we can say that that's also in steep decline at the moment. And so no sign of a turnaround there, which may help the broader market if and when that happens. Same for the advanced decline line. It's in a terminal decline, if you want to call it that at the moment. Not quite terminal, but certainly it's firing down at a rate that we haven't seen for a long while yet, maybe back to something like what happened here in 2019. If you can call it oversold, I know it's not a stock chart, but it does look like it is sort of getting pretty extended to the downside. So again, maybe we see some sort of recovery from here. If not a move back to all-time highs, then maybe perhaps just a relief rally off those low points. Looking at the relative performance across the three biggies in the US, and we can see the Russell and the S&P more or less equivalent. I guess the takeaway from this slide is that, the only time they were in positive territory was at the very, very start of the year, and then it's been downhill ever since. So about 24-25% down for the Russell and the S&P 500, and the Nasdaq, it's the one that really getting hammered, down around a third for the year, which is very big. Obviously the Nasdaq one contains all those big tech stocks, speculative stocks, and they are getting killed mostly because of the yield curve and the interest rates, which we'll get onto right now, in fact. So just a reminder before we get into what the yield curve looks at the moment. This is what it looked like mid 2021 when the party was still raging and the market was going up, everything was quite high, money was virtually free, and that's what's called a normal yield curve. And when risk is low, this is the shape you would expect it to be. However, fast forward today, and it's quite different. As you can see, it's even got the little inverted flag to helpfully tell us that that money is now much more expensive, and if you want to get short-term bonds, you're going to get a much better return than even long-term bonds. And when that happens, well, that's significant. It's a significant indicator of perhaps a recession coming forth towards us in the next 12 months or so, with a high probability. We can look back at the past and see, things like the top 2000 tech wreck, where we had that flat inverted yield curve. Same in 2007, the yield curve turned flat. Certainly not the shape that we saw rallying off the 2003 and 2009 lows. So we are definitely in that bearish territory. And if you look at the ratio, well, not the ratio, the spread, I should say, of the 10-year bond yield versus the 3-month bond yield, when it gets above this red line here, that's an inversion. That's when the 3-month is paying a higher coupon rate than the 10-year. And when that does occur, it's, as you can see here, these grey lines show the recessions, and it's quite a good indicator. It's not perfect timing. There's usually a little bit of a lag between the inversion and the recession itself. But as you can see, if we're not quite there yet, but it has spiked up previously, just before 2020. But we're getting very, very close to another signal on this particular indicator. On the sentiment chart, however, we are seeing that we're into this so-called bearish extreme territory where there's obviously a lot of fear around, and there's a lot of put buying going on to try and bolster up those holdings in stocks, and that demand for puts has pushed this ratio much higher towards that 0.75 level. And that's when it gets into this territory, it's often a spot where the market rallies from. We saw what happened when the COVID crash came. Everybody jumped into puts, and of course the market turned around quite quickly after that. The opposite happens when everybody's into calls. As you can see here, through 2021, everything was rosy, but it was actually overheating. That's the signal we were getting down here. Now we've got the opposite. So again, it's another sign that perhaps we could be on the verge of some kind of rally from here. On the VIX one, though, this is an interesting chart because, as we discussed earlier, the market has been going down fairly steeply, and yet we haven't had volatility spiking like we did back in 2020. It's kind of just stayed in this what I call the elevated risk area between about the low 20s and about 40. So while there is fear around, there is not a huge amount of fear. So one argument is, well, we haven't had had that capitulation move yet, where everybody wants to throw out the baby with the bathwater. So perhaps that's still to come, or perhaps this is a sign that things may actually improve. We'll have to wait and see. On the seasonality, this is the interesting things, because all the seasonality charts seem to be lining up. This is the annual seasonality for the S&P 500, so all the years combined. And as you can see, whilst the year-to-date actual at the bottom here hasn't been a great mirror image of the seasonality chart, what's interesting is that round about October we often get that low before a rally in towards the end of the year. So the question is, are we there yet, and will we see something similar this time around? On the presidential cycle also, this is actually quite a good analog for what's been happening in the market. We've got this downtrend here, and we've got this downtrend here on the seasonality chart. Again, it's showing a low round about October time that could lead us into a rally towards the end of the year. So again, is that what we're going to see this time? And this is another look at that presidential cycle, but this time looking at different varieties of that midterm year. And again, interestingly, all of those lines all bottom out round about the towards the end of October. So a couple of weeks away from where we are now, and they all rally in towards the end of the year. So again, perhaps we might see something similar. I mean, it really will depend on a number of factors, not just the seasonality charts, but certainly if the seasonality is turning more positive, then that gives a little bit of hope for the stock market. Switching now to the Australian stock market, and this is actually holding up a lot better than the S&P, as you can see. Just finding a little bit of support of that long-term trend line there as it rallied off the low of the previous month there, and as I said, it just seems to be holding up. Just find a bit of resistance under the old 2007 highs at 68.50 there. So we'll see if it can actually make any more hay over and above that just now. On the weekly chart, you can see that a little bit clearer. We actually had more or less a double bottom at that 6,400 level. It's now rallied off that level and heading again back towards that 68.50 mark. Ichimoku wise, it is in bearish territory. The price is through the chart. The lagging line or Chiku span is also broken through as well. So once again, we have to look overhead to get the resistance level, and it's set back about that 7,200 level, which is not far off where that sort of high a couple of months ago appeared. Looking at our Asian and American cousins, and you can see the ASX 200 has actually done relatively much better than either the big Asian indexes or the S&P 500, which are all down in those low 20 areas. Shanghai just holding up around about 16, but the ASX 200 down only 10% for the year, which isn't too bad. And you can see once again, it's just been sort of one-way traffic all year for most of these indexes. This chart here is quite interesting because this just shows you how good the XJO has been doing relatively against the S&P 500. If you just divide one into the other, you can see here for the pattern watchers amongst you, you'll see that this was classic falling wedge, and it broke out, and so it's now actually worth about 1.8 times the S&P 500, which is nice. Switching to the currencies now, and here we've got the world reserve currency behaving a bit like a cryptocurrency at the moment. It's just gone crazy through the roof. Obviously, the US interest rates are rising. That's what's been driving this more than anything, really. And there just doesn't seem to be any stopping this thing at the moment. It's got a lot of momentum behind it. It's broken through that 104 level, sitting up around about 114 at the moment. So you would think we would have to get a pullback at some point, but you wouldn't want to stand in the way of this market at the moment. And of course, that big move in the US dollar is, of course, constraining all the other currencies that it's crossed with. The Aussie dollar not immune to that, of course, just getting hammered at the moment. Broken down through this old 70 cents level, and it does seem to be making a move towards 60 at the moment, and we're just at 62. Obviously, a lot of momentum behind this move, and given the fundamentals and the state of the US dollar, I wouldn't be surprised to see it click over 60 in the next little while. Same for the euro. The euro is now worth just 97 US cents. I mean, who would have thought that we would see that any time? But there we have it. 105 was the big long-term trend line. It did kind of just try to sort of stabilize at that level, but it wasn't to be, and it's now broken through parity and just trading at 97 cents. Wowee. The British pound's been in the news a fair bit recently, of course. The new incoming Prime Minister over there, Liz Truss, is, she's not having a good time of it at the moment, mostly of her own making, but leaving the editorial to one side, you can see here that we're down at that 111 mark now, which is very low. There's parity, which isn't very far off, just dipped to 104 briefly before bouncing, and British pound's not in a bit of a sorry state at the moment. If you look at the very, very long-term chart of the British pound, you could see it's basically been in a downtrend ever since the Nixon shock, when they sort of tore up the Bretton Woods Agreement and took the US dollar off the gold standard, and it hit its all-time low of 104.85 when they had the Plaza Accord. And they devalued the US dollar. That kind of made it rally, but it's sort of stabilized. And then recently, of course, as we've seen, it's been down there. It has touched that all-time low, but it's just managed to stabilize a little bit at 111. But given the strength of the trend, it wouldn't be it wouldn't be a surprise, I guess, to see it dip below that 104 and maybe even hit parity. Japanese yen is also in a bad way. There's a lot of economic fundamentals working against Japanese yen at the moment, not least of which is the US dollar, of course, and it's just getting hammered at the moment. I wouldn't like to even guess where that's going to end up. Bitcoin is, Bitcoin's a risk asset. It's not digital gold. It's a risk asset. And, when everything else is being deleveraged, then, the Bitcoin is also going to suffer. And it's can't really catch a bid at the moment, although it has stabilized a little bit at this 19,000 level, which is previous resistance. It's just off the left-hand side of this chart. So it's touched that level 1, 2, 3, 4, 5, 6, about 7 or 8 times now. The volatility is completely dried up, as you can see. The question is, does it rally off this level, or is this just testing that level, and then eventually we'll see it go through? We'll have to see, but we wouldn't want to be a hodler of Bitcoin right at the moment. And lastly, on the commodities, the crude oil did sort of test this 112 area. It's now selling off back found support, I should say, on this 76 level just briefly. It does seem to be dallying with it a little bit, though. Recession obviously looming, so wouldn't be a surprise to see oil fall even further past that 76 level. Wheat has come back off a little bit, but it's still up at these big elevated levels. It's back through the 950 level and just hanging around that 850 level. This is what happens when the biggest wheat exporter in the world invades the fifth biggest wheat exporter in the world, and the stocks or the exports dry up completely. So, I think we can expect that wheat prices in general will remain elevated until the situation in Ukraine is resolved. And on the gold, you can see this 1925 level did prove a little bit too much. Had one go, had another go, more or less double top, and just sort of selling now back into the pattern. Broken through that 1700 level as well. So it does look like it's heading lower for gold. And copper also a little bit looking a little bit sorry for itself. Couldn't hold that 465 level. Very similar picture to gold, in fact, and it's just selling off back. The volatility does seem to be slowing down a little bit, but copper's a big bellwether in terms of economic state of the world, and with recession on its way, that wouldn't it's not surprised to see copper doing this. Interestingly, just as an aside, the knock-on effect of low price of copper, of course, is nobody's opening new mines because the price is too low, and copper obviously a massive component of the green revolution going forward. So low copper price is definitely not a good thing in many ways. The iron ore finally, and you can see here that it's back to this 96 level, obviously previous resistance, then support, and it's back once again. The old highs of 220 just seem like a long time ago, don't they? Definitely a downtrend for iron ore. So just summing that up, you can see that we have a downtrend in the US stock market. It does starting to look a little bit oversold, and it may just be approaching some key support levels. And we've also got that seasonality turning positive. So I'm probably going to have to eat my hat when I do the next one of these in December. But who knows? Perhaps we get some stabilization in stock prices for the last quarter of the year. Aussie 200 bouncing off that trendline support, certainly holding up a lot better than the S&P 500. So we'll see if that manages to hold for now. And of course, we've got this US dollar just, acting like a wrecking ball across the FX markets and just obliterating all the other currencies at the moment. And, as we've discussed, that recession on the horizon is having an impact on the sales of commodities, and prices are falling. That's it from me. Thanks very much for your time. And if you've got any questions, of course, shoot me up or follow me on Twitter. And I will wish you good luck, good trading, and see you next quarter. Bye for now.